Hello, everyone, and thanks for joining me. Today, I'm going to cover Athabasca Oil Corp presentation for October 29th to about Q3 2025 results. And we're going to go over some numbers and just kind of try to cover what the company has been up to. So they actually had a very good quarter, and the stock been performing really well. It's been at about 52-week high as of today. So I'm talking the beginning of November. The goal of today is really to kind of cover everything that's been going on and see where the company is heading, and obviously not financial advice. And you can see kind of the disclosure at the beginning of the presentation. But they have this vision of and strategy, basically growing production at Leismer to 40,000 barrels a day, expanding their Duvernay activities, and optimizing a Hangingstone. And so what they're basically saying here is that they have low decline, high quality thermal asset with 90-year reserve life index. Low decline and high quality really comes in the form of utilizing technology called SECD, where you don't decline as much relatively to kind of fracturing technologies. And they do have very high quality asset in Leismer, especially with the development of the kind of north side of the lease. And we saw a lot of those results in L8, pad L8, that they're kind of continuing expanding in that area. They have self-funded growth in high quality Kebab Duvernay oil play. So this is kind of a side business we're going to be talking about. And pristine balance sheet with net cash position. So they have about 335 million in cash. They do have some debt, so they do have a net cash position, but they've been like really good in buying back shares. So what we see here is the basically trajectory of growing liquids growth barrels per day from 2021, just like in the mid 30,000 barrels a day. At 2025, we're heading towards like close to 40,000 barrels a day. But by end of 2029, Leismer just by itself is going to be 40,000 barrels a day. And the idea there is to grow over 60,000, closer to 70,000 barrels a day, with Leismer obviously going to 40, Hangingstone maybe closer to 10, and that expansion that they talked about in the Kebab Duvernay oil play. So shareholder returns kind of overview here is that between 2021 to 2024, they had significant buybacks and deleveraging. So they've been paying down debt and buying back shares. And between 2025 to 2029, the idea is to generate free cash flow. It seems like 1.8 billion at 60% of market cap as of today, and basically continuing buying back shares. So that's kind of their value proposition. The reality is that they've been doing a good job kind of executing on that. So this is not something that we necessarily speculate at this point. It's just something that if they continue on the path they've been on, they could be successful. This is like quick overview corporate snapshot of the company. So 40,000 BOEs per day. They use BOEs because it's barrel of oil equivalent, not just BBLs, because they do have BBLs in Hangingstone and Leismer, but obviously they have this Duvernay Energy Corp business that they do have a hydrocarbon soup that they produce, where you do have light ends. But when it comes to thermal oil, they suggest it's predictable, low decline projects, which is true, efficient brownfield SAGD development, and unparalleled reserve scale, 1.2 billion. And many people speculate that it could be the next kind of acquisition, especially with MEG getting acquired and Athabasca being the next kind of SAGD play that at scale, that has certain scale here. And obviously they have this almost like a side business, Duvernay Energy Corp. They call it DEC, which is the pure play Duvernay subsidiary. It's self-funded and flexible development and de-risk resource and high margin. So basically what they're doing there, they're kind of cash flowing on that business, and then the cash they make, they drill more wells essentially. So kind of like legacy old school oil and gas development, where the free cash from thermal assets, it's really kind of free cash where they buy back shares and return value to shareholders. So when you look at the capitalization of the company, look at the basic shares. So 489 million shares. That's a big achievement for them. Just as somebody that's been covering this company for a very long time, I can tell you that this is one of those uh, aspects where you really confirm their strategy, because this share count was significantly higher, closer to 600 million 3 4 years ago, and so now 49. That tells you they're buying back shares aggressively. Now one could say, okay, well, share price was maybe $2 3 as they were buying. That's fine, but they've been buying all the way up to $7, and if you just to take the share price of today, canceling, let's say, 100 million shares, that's $700 million. But we're talking about current market cap of about $3.3 billion, right? So 700 million, and this is not exact science, out of 3.3 billion. If we just do a baseline today, that's fairly significant. So net cash 93 million. So obviously they do have that, with cash, pure cash, 335 million. And in my view, this is kind of their ability to not just go on offense with buybacks, but also play in defense with having that cash and liquidity of 466 million. So the company has been really good in kind of creating defensive mechanisms, but also offensive mechanisms when it comes to buying back shares. But at the end of the day, it's really about the business. If the business is able to generate money, and because they're low decline and low cost of supply, they're able basically to collect the margin and buying back shares, regardless of kind of the amount. Sometimes it could be up to 10% of the NCAB, um, but sometimes they, under certain conditions it could be 5%. But I think as long as they kind of continue on the strategy, it could be very powerful compounding effect. So 2025 guidance, we get between 33,500 to 35,500 BOEs per day in thermal. You can say barrels per day, because it's just pure barrels. The density is very close to the one of water. And on the Duvernay Energy Corp is about 3,500. Now, what we've been seeing in their recent earnings is that they produce close to 40,000 barrels a day. And so that's really positive, right? And so especially if they grow the Leismer asset to 40,000 barrels a day. Adjusted funds flow, 475 million to 500 million, and 45 million in DC. As I mentioned, that adjusted funds flow is being kind of, um, you know, it's a little bit different than utilization of the cash coming from the thermal business. When it comes to capital, 75 million in DEC, so continuing kind of reinvesting into that business, and capital for thermal business, 250 million, with free cash flow 250 million. And so basically, they spend 250, they free cash flow 250 under certain assumptions that could be seen in the slide, but at the same time, the production is expected to grow because of the optimization at Hangingstone and growth at Leismer to 40,000 barrels a day. So, as I mentioned in Q3 2025 results, they produced closer to 40,000 barrels a day at 39,600 BOEs per day, 98% liquids. The cash flow was 129 million adjusted funds flow, and the netbacks were 43, very strong for thermal, and 33 for Duvernay. And that's what I'm talking about when I'm saying low cost of supply, kind of low decline, because you're able to generate significant netbacks from those operations, especially with both of those assets being pre-payout royalty status, which means basically they don't pay as much royalties as they kind of following the government's program to break even on the past capital expenditures. Capital for thermal, 65 million for the quarter, and 31 million in Duvernay Energy Corp, and 100% return of capital, 192 million share buybacks year to date. So 192 million shares, right? Where in sorry, 192 million dollars share buyback. So if you take divided by 6, so it could be, let's say, 100, 200, 20 million or so, right? So yeah, so it depends kind of what price they were doing it at. So let's say 192 divided by $6 per share, so 32 million shares, right? So 32 million shares, or maybe like if they're buying closer to 7, on average. So 192 divided by 7, we're at about 27 million shares, right? So, but 192 million dollars share buybacks year to date. And as mentioned, they have a very good, pristine balance sheet, 93 million net cash, and 466 million liquidity. So, and the net cash really coming from taking the cash 335 million and subtracting their debt that they have. So as we're looking at net production, again, the idea is really to grow production to 2029 significantly. You can see the biggest kind of angle there is really from Leismer expansion. Hangingstone kind of looks the same, but I think Hangingstone has opportunity to grow a little bit more, especially with infill integration and seeing the two recent well pairs that they drilled. They were really good, and so 15% CAGR, so compounded annual growth rate, and over 25% per share because they continue buying back shares with the cash. On net adjusted funds flow, you can see significant kind of boost towards 2029 with obviously huge sensitivity to oil prices, and every dollar in WTI is about $10 million sensitivity, and every dollar change in WCS is $17 million sensitivity. So obviously they rely on commodity prices, but nevertheless at $70 US WTI, they expect to generate 1.8 billion free cash flow. So that's fairly significant because we're looking at potentially like $2 per share. So now it's $7 the stock price. But then if it's only half that, right? So it will be, let's say, $1, which is also significant in the next 4 years, right? So this is just something to be mindful of. When it comes to business outlook, thermal oil assets with low base decline. So again, Leismer brownfield growth to 40,000 barrels a day by 2027, and the capital is being spent as we basically speak right now. Hangingstone steady free cash flow generation. I really think they under kind of communicate here on Hangingstone. I think Hangingstone is going to be a very important asset for them, especially with those two well pairs. As I mentioned, they've been doing really, really well. And again, they haven't drilled new well pairs in a very long time, and so this year was a very important year for them to see what else could be done at Hangingstone. And I think with NCG co-injection and redrilling infill integration, they could have more success than they maybe communicate here. Corner ramp up to 15,000 barrels per day by 2029. This is a very interesting angle here because, and this is something I have to kind of adjust myself to in a way because um, it seems like they will be doing some greenfield expansion. I'm not a greenfield SAGD investor, so this is something I'm going to have to really think about because there's some risk involved with that. But the corner asset is really good quality geology there, and so this is something that kind of motivates me, to take a deeper look into their plans for that greenfield development. But really, the main benefit of this company for me was always, at least for the past 4 or 5 years, is that there's so much to optimize in the existing assets, and especially with having cash on the books and very low debt and opportunity to kind of really net back in a very low decline, basically low spend environment, is that greenfield is almost like that next kind of leg that takes this company further. And we've seen Cardinal Energy and IPCO doing really well when it comes to greenfield development, but it requires a certain type of investor that is okay with that type of plan, right? So I'm mentally going to have to kind of adjust how I think about this company with corner development, greenfield development. Duvernay Energy enhances growth. So I actually think in some point Duvernay Energy Corp, maybe it's not going to be maybe a standalone entity in my view, but it could be something that could be bought out in the future by some other player, maybe Whitecap, Varen there in the region as well. So we'll see what happens, I guess. But as of now, they're looking at this as a self-funded independent capital allocation framework for Duvernay Energy Corp. Competitive positioning. So 5-year average growth capital break even at 50 USD for WTI, so $50. So again, this is the low cost of supply operation here. Strong balance sheet, as mentioned, 93 million in cash, tax-free horizon. So they have significant amount of tax pools, so 2.1 billion of pools. And they, as mentioned before, their pre-payout crown thermal royalties status, where they pay only 6% at $70 WTI, and now with $60 WTI, even less. And as I mentioned, 100% free cash flow to shareholders, 1.8 billion free cash at $70 WTI between 2025 to 2029, and that gives you a horizon. I don't know if they're going to be able to actually achieve that, but even if they achieve half of that, maybe zero point 0.9 billion, this is significant as they continue buying back shares, right? So, for example, if you buy at $7, 100 million shares, that's going to be $700 million, right? Um, and so that will be like a slice of that free cash flow, and this is significant because the current enterprise value is about 3.2, 3.3 billion. So you kind of compounding, and that's kind of what they're alluding to here at 25% per share compounded annual growth, and so it really gives a perspective for investors. So over 20% cash flow per share CAGR over 5 years, right? So that's kind of really the opportunity. And you know what? If it was a different company and they said that, I would be a little bit skeptical. But because they've been pretty much executing on the strategy, and many people caught by surprise that they've been actually doing that, I see a lot of potential for them to continue on this path. So let's talk a little bit more in depth about thermal oil asset overview for initially for in overall thermal oil division. So you can see AOC, so Athabasca Oil Corp, Leismer, Corner, and Hangingstone assets in yellow, and currently 37,000 barrels per day, 250 million capital expenditure program is mentioned. Breaking even at $50, $8 per barrel sustaining capital, and huge reserves. So you can see some numbers here, right? Just 1P is significant at 400 million barrels, but 2P goes to 1.2 billion. 2C reserves, best estimate is about billion barrels. But I mean, those are significant assets, and the reality is they can't really produce that, on daily basis because they're constrained by the facilities that they have in place. That's why they're expanding on Leismer. That's why they want to bring Corner online, and so they have those reserves. And what it really means for investors is that they don't really have to buy anything, and they're very likely an acquisition target for somebody else that's looking at these numbers and thinking, man, if I buy these guys like today, I could grow production, advance kind of the separations, and gain this value for the next 50, 60 years, right? So that's kind of the thought process for maybe somebody that interested in acquiring them. And they're at the McMurray Fairway. And for me personally, for the longest time now, the most exciting kind of asset within those assets, and kind of the smaller portion of the Leismer asset, was the L8 pad expansion there that they've done, which showed a Meg Christina Lake type of operations, geology, execution. Maybe the SOR is a little bit higher, but nevertheless, the oil production rates like 1,000 barrel a day per well. There's I think a well that produces 1,500 barrels a day. Like they've been doing extremely well when it comes to their execution. And when I think about, soon we're going to talk more about Leismer, but when I think about their operations, I can maybe provide a little bit more kind of what's going on there. But you can see here in this slide, right? L8 is located kind of in the northern quarter there, and CPF, it's kind of to the east of the operations. But current production at 28,000 barrels per day, and that's the best they can achieve based on their current design of surface facilities. They cannot produce more than that. And so as they grow their facilities, expanding their facilities, kind of brownfield optimization, debottlenecking, adding more equipment, adding more steam generation capabilities, they will be able to grow this asset to 40,000 barrels per day as they're able to handle more liquid at the back end. And so what you see here is long reserve life of 70-year current reserve life index. So 70 years with about close to 700 million barrels being at 2P reserves, right? And so best estimate is about 468 million, which is significant. If you start kind of dividing that number by 40,000 barrels per day and the number of days, and that by years, you get to a significant amount of years, right? We're not talking year or two, we're talking about um, decades, basically, essentially. So excellent reservoir underpins low corporate decline. New wells have flat production profile for 5 to 7 years, and the reason for it is because the steam chamber growth it takes time, and that heat transfer of steam to every layer of oil is more and more oil drainage. So that's kind of why they're saying that the flat production profile, as the ESP producing very kind of specified liquid oil rate based on the constraints that they run the speed at, just trying to control maybe the gas production rate. And the steam to oil ratio is about 3. So nothing wrong with 3. It's just there's a little bit more kind of nuances there with geology, but it's really good when it comes to operational netback of $45 per barrel, and really low prepayout crown royalty status of 5 to 9% until 2027, as you consider the flow rates. So 2025 base activity, 235 million spend. I think this is excellent because you can see in the wedge here base production and the sanctioned 40,000 barrels per day expansion really takes them in 2027 towards the slag. And if you think about Meg Energy getting acquired for $8.6 billion for about 100,000 barrels a day, 108,000 barrels per day as of today, and you think this asset is going to 40,000 barrels a day, and you kind of take a ratio, let's say 50% of that, let's say 4.2 or something like that, and 80% of that 3.5, 3.6, you quickly starting to realize that the enterprise value for the company is the probably value of Leismer in 2 3 years. And so this is something that super exciting for me. This is something I've been talking about for maybe for years now. I mean, people that have been following me, they know that I've been saying that even when the stock price was like $1, $2, $3, just having that kind of vision of them achieving that, and that geology. When once I saw the core, I was like, yeah, this is something they have to pursue, right? This is something they have to do, and so I have to admit the team been executing amazing. And also they've been doing a good job on kind of the legacy wells next to the CPF when it comes to in situ co-injection, ridge drill. So 6 ridge drills on pad L1 placed on production in February. So this is great. Pad L10. So this is basically kind of taking advantage of the L8 region, and 4 previously drilled wells to support production in the second half. And pad L11 spot 6 new well pairs, right? So flexible progressive expansion to 40,000 barrels per day, where they kind of already drilling and setting up the stage for that CPF, so central process facility, to be able to handle that emulsion that's going to be coming online in the upcoming years. And so I think they're doing a really good job here, executing with excellence. High netbacks, low cost of supply, low decline. I mean, if you're investing in oil and gas sector, this is something for me that's always very exciting because the story is very clear and there's like no noise here. I mean, the only thing that maybe could hurt this company is probably low oil prices, right? But I mean, they have like really good history after surviving 2020, really coming back like a phoenix, rising from the ashes and doing a good job. I think the stock is up something like 50 times from the very lows. I mean, but maybe they have this PTSD from during COVID, going through the struggles and coming from the other side and doing a good job, kind of being disciplined with keeping some cash, low debt, and growing, but in a responsible way that makes sense to me personally. Now, if we think about a little bit more about the Leismer expansion to 40,000 barrels per day, progressive expansion that they have, they actually been kind of growing the asset for some time now. If you think about 2022 timeframe when oil prices were very high, they were at 120 or so dollars per barrel, mainly because of the Russia attack on Ukraine. We saw 20,000 barrels per day oil production just at Leismer, right? And so you can see over 2023, 2024, 2025 timeframe, they're really able to grow it to 28,000 barrels per day, mainly through debottlenecking and kind of adding new equipment to handle the emulsion. And now they need this extra leg to basically generate steam to produce more oil and handle it at the back. And so what you see now is them exiting 2025 with 28,000 barrels per day, and 2026 growing to over 30, but exit 2027 with 40,000 barrels per day. So project cost is 300 million dollars. And if you think about this incrementally, so Meg gets acquired for over 80,000 per flowing, and if you add, let's say, 10,000 barrels per day, 300 million, that's 30,000 per flowing, right? But they're adding 12, so that's a little bit less. So that will be about 25,000 per flowing on the cost side. And so I'm not suggesting the value of Leismer is the value of Christina Lake Meg, but if you're able to develop something for 25,000 per flowing and maybe sell it for 70,000 per flooring or 65,000 per flooring, this is just a good business, right? So the incremental rate is 12,000 barrels per day. So in addition to the 28,000 barrels per day that are currently flowing, and the capital efficiency they're telling us here is 25,000 uh, barrels, right? Dollars per barrel, so 25,000 per flowing, and that's kind of what I was thinking as well. From McDaniel's study, 2P NPV is 3.7 billion, which is over their current enterprise value, and so there's significant value here. So people that complain about oil production increasing for assets like this, I cannot blame them because that's part of part of capitalism, part of what investing is all about. Because you want to invest something for $25 and you want to sell it maybe for $75. You want to create that value as part of the capitalistic society that we live in. And so this management team is doing a good job basically identifying opportunities and deploying capital to monetize and add value to shareholders, which is kind of what you would expect management teams to do. And um, so I do understand people kind of get emotional about companies growing production, but in this specific case, it makes a lot of sense to me personally that they're doing that. That's why I'm more of a brownfield investor versus greenfield. And as I mentioned before, it seems like they want to pursue corner as well, which is going to be an adjustment for me personally. So this is something I'm going to have to kind of think and do more studying about kind of how they're going to pursue corner and what type of scenario is going to be unfolding here. So they do have regulatory approval for 40,000 barrels per day on for Leismer, which is great, right? So the regulator already approved those barrels to be produced in the future. No egress expansions required. Established transportation to Edmonton. Long lead steam generators acquired countercyclically during COVID. You may remember my old videos about this company where they already have the steam gens and they just need to install them, which is kind of funny, right? Because that's kind of very expensive. But nevertheless, good job for them identifying that and integrating this equipment today, right? For Leismer to get to 40,000 barrels per day. So facility capacity expansion is 130,000 barrels per day for steam to be generated. And again, just a reminder that this entire exercise for those assets is to be able to generate steam so it can be injected, heat transferred, and oil to be produced by gravity. And what they're saying is that facility capacity expanding to 130,000 barrels per day. Now, if you take the oil ratio here, right, and divide by 3, you will get about 40,000 barrels per day, right? 4 times 3 is 120,000. And so there's a little bit extra here for 3.1, 3.2 SOR. And 40,000 barrels per day bitumen processing will be able to do that with the new facility installed. And as mentioned, 300 million project capital, 50% complete by year end 2025. And that gives you a perspective that now from the cash that needs to be deployed is going to be 150 million. 190 million goes to CPF capital and 110 million to Wellper capital, which is actually not that bad because even if you don't have the central process facility expansion at 190 million, which is super cheap, right? You still need to drill new wells and drill new pads. And so in a way, I'm kind of looking at this like this is actually cheaper than I initially thought because I didn't consider that the wells are included as part of this expansion. but seems like they did include that, which again could be another value added here where people maybe didn't really identify that the additional benefit. So Hangingstone, again, people, in the past would tell me this is basically zero, they're not making any money. And I'm like, no, dude, like this is like a really good asset that people just, I don't think understand very well. And the reason why I think so is that because since like 2025 or 2026, the well count was something like 23 well pairs, and it was like 25 up until recently. So recently they drilled two new well pairs. So if I was to tell you, let's say for the Permian or any other operation, is that you didn't have to drill any wells to keep production somewhat flattish, right? As you can see here at 7,500 barrels per day. Would people believe that? I don't think so, but Hangingstone was able to deliver on that to very trickle down on the production decline. But the team did a very good job kind of sustaining production without spending any money. And then the question is, where was the money spent? And the money was spent in L8 Leismer and growing Leismer, which is a better geology asset, to 28,000 barrels per day. And then the remaining cash was used to buy back significant amount of shares, like I showed before, getting us to 489 million shares. And the other portion of the cash was used to deliver the balance sheet, right, to get to something very logical. And so now we find ourselves in a position where there's over $90 million in net cash. So project highlights. So this is very exciting for me personally. Current production at 9,000 barrels per day. And the reason why it's there is because the two additional well pairs, on average, they're producing about 750, it seems, right? So 1,500 barrels per day additional production to the legacy 7,500. And they're able to kind of, um, you know, bring it higher. So, and we can see on the map that they have very kind of concentrated area where they develop those pads and drill the additional two well pairs. And from the development point of view, future well pairs as we go into the future, able to sustain that production. So then the question I have is, how are they able to be at 9,000 barrels per day with two new well pairs and basically sustaining production at 7,500 barrels per day? And so what we see here is that that production, what they say, yeah, it's going to nine, but then it's going to decline. And the reason why it's declining is because the capital is being deployed elsewhere. But that gives them an opportunity to optimize it even more in the future. I actually think those two well pairs will do a little bit better for longer, just kind of looking at the initial kind of flash production and steam chamber development, in my view. But if they choose to maybe introduce infills, they could maybe even sustain that production even at 9,000 barrels per day with very low cost of supply and maybe like, I don't know, a couple of $1 million integrating infills and then bringing that kind of curve a little bit higher. So I think there is significant opportunity here for further optimization. And this is kind of like a bonus option they have um, for future redevelopment. But they have very smart people working on this asset, and I'm sure they will make smart decisions. The other thing that's like really misunderstood about Hangingstone is the significant reduction in their SOR, and so they're able actually to do more with the steam that they have that generated by the facility, because what they're doing there, they're co-injecting NCG. So they co-injecting non-condensable gases to maintain the bottom hole pressure in those legacy kind of reservoirs and reallocate that steam elsewhere. So I think it's another opportunity for that asset. Long reserve life index, so 50 years reserve life index, 163 million barrels to P reserves, and close to $1 billion dollars in McDaniel's to P NPV10 value. So fairly significant. But then again, this is something. This asset is fairly small, and it's pre-payout in royalties, and it's a little bit more expensive on the cost of supply, but it's just kind of like it just makes sense to me that it's just kind of in the background, continuing cash flowing while they're growing those like really homogeneous reservoirs in Leismer and Corner. So, as mentioned for 2025 activity, $15 million spend. two extended reach sustaining well pairs on production in March, PED AA, and it's kind of like to the west to the legacy well pairs that probably all coalesced at this point. And production rates 800 to 1,000 barrels per day per well, right? So if we looking at 7,500 as a legacy kind of base production, and those wells are currently aggregate 9,000 barrels per day, so 750 each or so, 800. So that's okay, If they continue doing that, that could be amazing. So cash generation, 300 million operating income over the last 3 years, and Q3 2025 operating netback is $39 per barrel, and low prepayout crown royalty 5 to 9% into 2030s. And the reason for it is because they're constrained by the facilities. They can't produce more than the production rate that we're currently seeing. So 9,000 barrels per day or so, or 7,500 at kind of the baseline. And and we go from there. So now I want to talk about Corner future growth. Corner is a very, very important asset, but it's greenfield, right? It's not brownfield expansions or optimizations to already producing assets. This is Corner is something you start from the start. And for somebody like myself, it's kind of a little bit intimidating, to be honest. But what's really interesting about this asset is that the reservoir pay is very high, so it can be up to 45 meters with average at 21 meters. But this oil saturation is 84%. So if you think about the sand, so oil sand, you will have from the saturation within the sand, you will have or mixed with the sand, you will have 84% oil saturation, which means 16% will be water saturation, and the effective porosity is going to be 35%. So porosity is really good. Now permeability, horizontal permeability in Darcy's is about 6.1, which is way higher than Meg Christina Lake based on what they're suggesting here. It's about 5. But I do know that some wells there, they have, some regions in Meg Christina Lake, they have permeability closer to 6. But it's okay, it's good. Like you can have wells that produce 1,000 barrels per day, and nothing wrong about that. And based on this matrix here, it seems like this asset is somewhat more superior to even CNRL's Jackfish, right? So this is just something to consider because the pay is higher, the saturation is higher, the porosity is higher, the permeability is higher. So there's lots of moving parts here that are very positive for development. So if I was to say, would you want to own like a Jackfish asset, CNRL's Jackfish asset, or you want to own something better, right? So that's what Corner is. But Corner requires greenfield development. It requires facilities. It requires a central process facility that generates steam. It requires a facility at the back end that handles emulsion, that separates the liquids, the aqueous phase from the oleic phase, where oil goes to sales and maybe water is being repurposed to generate more steam. And so we have an environment here that we have to consider that cash could be deployed here significantly to grow that asset from 0 to 15,000 barrels a day. So it's a very de-risked asset because it's been uh, we utilize in those oil sands assets to better understand them. We poke holes, vertical holes, and we call those wells strat wells, so stratigraphic wells, where you can take the core and really understand what's there. And so that asset been delineated, so basically well understood, where you can tell what's where and what's the best geology and where to pursue the development. That's why I think the CPF is a little bit central to the kind of the banana shape of the Corner asset, because you can kind of go central, you can go west, you can go east. So they want to be close to everything, and I think it's very logical. So regulatory approval for 40,000 barrels per day, but my understanding it will be kind of like a phased approach. 350 million to P, 304 delineation wells that I've been talking about. See, so I'll just sometimes will say things without reading the slides, and it seems like I've been consistently able to kind of forecast what the slide is even going to say, which is kind of cool. But yeah, so 304 delineation wells locations. So those are the strat wells that I've been talking about, and 80% 3D seismic coverage. Really good understanding of the lease, really good understanding of the geology, and it's super de-risked when it comes to kind of development of that asset. Located in the heart of McMurray in situ fairway, adjacent to Leismer with shared area infrastructure, high quality reservoir, analogous to top tier projects. And I talked about that it's better than Jackfish. It's kind of comparable to Christina Lake Mag. And so this is super exciting, right? Because if we're thinking about this asset going one day to 40,000 barrels per day, Leismer going to 40,000 barrels per day, we're kind of getting close to that mag valuation, right? So when it comes to production, and I just don't know how people that kind of in the business of acquiring SECD assets looking at this and not considering acquiring that. So in the future, potentially. So again, a lot of moving parts here, but you can see how the story just makes sense. So pre-sanction activity, planning modular design for progressive growth. Again, I think, so this is something, if they were to say we're going straight to 100,000 barrels per day greenfield expansion, I'll be like, oh my God, I just can't be part of this. It's just too scary, right? I mean, I know historically um, some companies pursue those, and this is huge capital expansion. It basically, if you go into low oil price and you go and develop those assets at 100,000 barrels per day, spending like billions, potentially billions of dollars. This is very scary for me personally. But what they're saying here, hey, 15,000 barrels per day, project with 3-year time frame to first oil. Anticipated initial instantaneous SOR is less than 3. And this is a function of the geology. So competitive economics, so 30,000 per flowing, so 30,000 per flowing on greenfield execution, right? So, and that's really the Serafina model, right? That's really the IPCO model. That's the Cardinal Refford model, where you develop something for 30,000 per flowing and maybe you sell it over 60,000 per flowing, over 70,000 per flowing, right? But this one is even better than all of those other assets that I've been talking about just by me looking at the geology, because the geology here is extremely powerful. Self-funded growth, sanction ready in 2026, contingent of favorable macro, double-digit cash flow per share growth into 2030s. Phase one funded through cash flow, strong liquidity, continued shareholder returns during growth. It makes a lot of sense to me for them to do this. As I mentioned before, I have to mentally adjust to it because corner been in the back, kind of on the back burner a little bit here for the last couple of years, and I was very happy that they were able to buy back shares aggressively and do it this way. But this is a real project, very important project. But as we're thinking about this, 30,000 per flowing on the development and 15,000 barrels per day. So let's say, you know, they could be up to maybe 400 million, let's say, right? Something like that. Basically, they're saying here, um, so for every 10,000, you'll spend 300 million. You know, where's this cash coming from, right? And so they're basically saying maybe we're going to be self-funded here, right? So it's exciting from one perspective. From other perspective, it's kind of like, are you going to be able to buy back shares at the same rate, or now the market will have to view it a little bit differently, more like maybe Cardinal, right? Which been doing extremely well. So maybe that's why they have this confidence that, hey, regardless of whether we aggressively buying back shares or growing production here through corner development, we're going to be able to monetize it and grow that production per share regardless, right? Whether we decline in the shares or whether we increase the production, right? So that's kind of, I think, the thought process here. So Duvernay Energy Corp, so shifting from thermal now. So it's basically like a private company. Athabasca operated. Sunnova's 30% equity owner in that. You may recall there was a JV partnership. And this is light ends. So equity ownership 70% Tabasco, 30% Cenovus. Production guidance for end of 2025, 3,500 barrels per day. 2025 exit 55 to 6,000 BOEs per day. So that's significant and very important to know. Capital for 2025 and 75 million. And as we go, Q3 liquidity, including cash, was 48 million. So it's a kind of like an asset that in a way breaks even but grows production. So there is no buyback shares here, all that concept. They're basically, scaling the operation, and they have a lot of very interesting neighbors. You can see on the map CNRL, PetroChina. We can see uh, White Cup. I talked a lot about that. So Paramount, I think that's what it says there. So Athabasca basically runs this asset and under the Duvernay Energy Corp structure. So 200,000 gross acres, 444 gross well locations, strong liquid rich netbacks, 33 BOEs in Q3, dollars per BOE in Q3, operatorship of strategic infrastructure, and the catalyst to accelerate value creation. So self-funded development within DEC with growth to 20,000 BOEs per day. And so now, guys, we're kind of starting to put the picture together. Okay, so Hangingstone, let's say 7,500. Okay, I think it's going to be closer to 9,000, to be honest. Then we get Leismer at 40,000, so 40,000. This 20,000. So now we have already 67. Yeah, and corner is 15. So 80 something, 82,000 barrels per day by 2030 or so. So that's the vision, right? It's in 5 years. So in 5 years, basically, production for this company doubles. Current enterprise value is 3.2 billion. And so the question is, what's the value of this company in the future, right? And so those are the type of thoughts I'm having about this company in end of 2025 right now as we speak. And many of you watch my videos for years now, and we're kind of evolving here, but you can see it's not bullshit, right? You can see that it's real and things are kind of happening here and unfolding, which is very exciting. So here's the map of the activity map with the neighbors and oil window. We've seen oil window assets getting acquired just recently. Nuvista got acquired. uh, Arc is in the kind of in that um, you know rich oil window in the Montney, right? So different, but that's what we're talking about, oil windows, not necessarily Duvernay K-Bop windows, but Nuvista had this window in the Montney, right? So got acquired. So it's not as gassy, right? So it's uh, liquid rich areas. So somewhat exciting, I think, for somebody that's interested, whether you're interested in Duvernay Kebab region, whether you're interested in Montney. I think those oily kind of hex and pentane regions are very exciting for some people. Okay, so these are the type curves, very different. You can see it's not as flat as SAGD oil production for illustrative type curve purposes only. But if you're able to capture the oil price, environment and really flush that initial production as you frag those wells, you're able to really net back significantly. And we can see some of the numbers associated with Duvernay development plans. So for 2025 activity, 75 million capital, 100% working interest operated activity, 3 well pads completed in September on stream in Q4. That's why they want to the guiding production a little bit higher here as we go into the end of the year at 5,500 to 6,000 BOEs per day. So this is very significant. 30% working interest JV activity. So 4 well pads, well pad on stream August, and multi well pad to spot in Q4 on stream in 2026. And we can see some kind of economics here, right? Where you have 2 well pad capital, so $14 million, 593 BOEs per day. You can see the IRRs at 72% and recycle ratio at 3.9% for the 2 well pads, and payouts 14 months. And this gets a little bit better for the 4+ multi well pad situation where the payout is 9 months. So, and I think it could be even better if oil prices increase and you're able to produce that flush production initially instead of going to the tail of that production. So when it comes to long-term development activity, development plans to be funded within cash flow and flexible for a range of commodity prices. And so if there was one kind of negative thing, I want to talk about um, is that everything is kind of being self-funded in a way, right? And so we really rely on oil prices here to support the netbacks fund self-funding growth at Leismer, growth at Corner, the sustaining operations at Hangingstone. self-funding Duvernay Energy Corp. And so a lot of things here are kind of sensitive to oil prices. But I think that it also creates an opportunity to run it like a portfolio where maybe you're okay with not spending money in a certain time period where prices decline, and you keep that optionality. You're saying, look, I'm not going to spend that cash. I'm going to maybe buy back shares or something when opportunity rises, and being more kind of capital discipline. And I think they did a good job historically in the last 3-4 years showcasing that to investors. Deep drilling inventory growth target of 20,000 BOEs per day, 75% liquids in the late 2020s. And again, there's huge appetite today in the market. We saw Vintiv acquiring Navista, where they're looking for higher liquid cuts, right? Again, not to confuse Montney with the Duvernay, but you get the idea that we're currently in an M&A market where liquid-rich assets are kind of getting acquired. Okay, so appendix here: capitalization and hedging, consolidated capital structure, long-term debt. So $200 million, 2029 unsecured notes, issued August 2024. You may recall they refinanced the balance sheet a little bit. 5-year term to 2029 at 6.75% coupon. So that's really, really good. So there's no urgency here to pay down debt and kind of kick that can down the road while keeping cash on the books. Strong liquidity for both AOC and DEC, 418 million and 48 million respectively, and 335 million in cash, right? This is always something. As mentioned, again, one of the disadvantages, but I guess it applies to oil companies, is the adjusted funds flow for sensitivity when it comes to WCS, WTI, FX exchange, and ACO, which the least concern, I guess. But every change in WTI, so we go like in recent days from $59 to $60, you get extra $10 million in adjusted funds flow. But WCS differential, if it becomes higher, this could be very significant. I mean, if we go to $25 spread, which is from here, I think it's about $13. 17 times 13, that $200 million in adjusted funds flow. This could really hurt, right? So this is something to be mindful of, where investors should appreciate the fact that these are oil companies and sensitive to oil prices. So here we have WTI Q4 2025, 5,000 barrels per day, hedged at $70 per barrel. WCS diff hedged at $13 per barrel. So just now we talked about being closer to $12, which is pretty good. And WCS diff for Q1 2026 hedged at $12.50 per barrel at 2,000 barrels per day. C5 diff input cost 2,000 barrels per day at $1 per barrel, and you have gas input cost at at 2 and 2.78 at 27,000 and the 25,000 gigajoules here. So per day, right? So not significant, but also the sensitivity on the tornado chart is not as impactful. But nevertheless, companies trying to structure kind of opportunistically defense mechanisms, and I think they've been very good at that, trying to kind of offense with buybacks and opportunistic deployment of capital to kind of grow production and expand, especially in the low cost of supply assets, and then defense mechanism through strategic hedging, basically very low royalties, pre-payout, which has nothing really to do with them deciding, but it's a huge benefit to them, and huge tax pools eventually, right? So the way I think about this, minimal taxes, minimal royalties, good balance sheet, a lot of cash on the books, and so it's a very good operation in my view. And again, not investment advice or anything. You saw my disclosure at the beginning of the presentation, but I think this is just something to consider. Very good company. Differentiated long life reserves. So we talked about this in detail about the various life reserves they have. And egress outlook, again, this is kind of speculative, but we have an opportunity here for Enbridge Mainline expansion 2027, TMX optimization by 300,000 barrels per day by 2027 plus. And so there's an opportunity here to really maintain the differential on the lower end. and obviously tax pools. So you can see here illustrative tax pool valuation. So and start kind of adding per share what it means. So let's say $2 per share, but I don't think so. It may be like a percent of that. Kind of like when you do taxes, you get $2 per share, but it's like 90% of it is not really deductible if you kind of think about this. I mean, it's realistic for them if they kind of use it on the balance sheet, but I think if somebody acquires them, they're not like paying $2 just for that. They're gonna pay maybe like 50 cents or 40 cents in addition to the $7, which is still great, right? It's significant, but I think it's very valuable for their operations, and I think that's why if when companies like this get acquired, a lot of investors may be like a little bit upset about that the tax pools were not utilized for the company. It was basically uh, being acquired for the benefit of the company that acquires them, especially if they don't pay premium to those benefits. But again, it's a kind of area where people could really argue a lot about. Oil sands royalty rates. So we talked about pre-payout and post-payout. Look at the post-payout status assets. Significant 25 to 40% royalties, right, on the gross revenue, where here we're talking up to 9%. So Athabasca advantage is that at $70 WTI, Leismer to remain prepaid till late 2027 as the projected flow rates, and Hangingstone to remain prepared until 2030 plus because of the lower oil production rates. So very, very significant benefit to this company. Okay, so this is my disclosure here. Thank you so much for listening. Leave in the comments thoughts you have, maybe feedback on this presentation. Hopefully, you found a lot of value in that. I know I did. The one thing that very important to consider about corner is that it seems like they accounted in the capital expenditures the pads and the well pairs, but I didn't think originally that that's included. So that's the one thing I learned today that was very useful for me personally, and I'm a little bit more excited now about that greenfield development. But anyway, hopefully you found lots of value in that. It's been kind of surreal experience seeing what the stock been doing and how they've been executing for the last couple of years, and me making those videos. I think it's like my fourth year talking about basically Leismer and the opportunity there and Hangingstone, and just seeing all those things kind of unfold. It's really encouraging and super exciting. So all the best. Thank you very much, everyone, and we'll talk soon.